How's it going everyone, Mario here. In this video we're gonna dive into some fundamentals of the market and cover what's going on with the economy and why is it important that we understand the impacts that it can have on our day-to-day lives. We are at a point where we need to cover a bit more than just charts and understand the fundamentals. In order to understand this, you gotta know a bit of a backstory. Now in the past recessions, Fed was there to save our ass. We call this Fed PUT. Every time the financial market tumbles, Fed intervened to stop the massive selling. During 2008 financial crisis, Fed implemented something called quantitative easing, which was the biggest monetary experiments in history. They lowered the interest rates to near zeros and started buying bonds and mortgage-backed securities. When interest rates are reduced to near zeros, yields will plummet, thus boosting the bonds through the roofs as bonds and yields are negatively correlated. Markets had a massive reversal after being down like 50% in 2008 and started making new highs by 2011. During 2018, Fed decided to increase the interest rates which it lowered at 2008 as the economy was getting strong. Unemployments were at all-time lows, but this cocaine-addicted markets gave a reaction with a 20% drop. Fed got scared because hey, if billionaires starts losing money, we gotta do something. Mandates my ass. So they dropped the interest rates rhetoric, kept the interest rates to near zero, kept the party going, and the market pushed higher and higher and higher. Then came 2020. The thing crashed the markets. The Fed doubled down on the quantitative easing again. That gave the best bull markets in 2020 and 2021. Remember, all these printing comes at a cost. The disadvantages of quantitative easing is there is a high probability of elevated price pressures, aka inflation, to show up if it's not handled properly, which is what we are seeing right now. During 2018, Fed increased their interest rates, or at least tried to, in a strong economy. But currently the situation is different. Raising interest rates in a weak and slowing economy can have huge negative implications. Currently, the situation is either increase interest rates aggressively and push the economy into recession, then slowly lower the rates as the inflation drops. But hey, our politicians won't like that. Recession during your term means nailed to the coffin to getting re-elected the next term. Anything to keep in power, eh lads? Who cares about us broke bums have to go through? Or increase the interest rates gradually and let the inflation run for a while to avoid recession but risking hyperinflation or even depression. There is no soft landing here. These are the only two ways which things can play out. So, in this scenario, where to park your money? Coming back into the stock market, what is a safe haven? Let's go over one by one. The only similar statistics which we have to compare the situation which we have right now is in 1970. We had the Vietnam War in 1970 similar to the ones which we have in Ukraine right now. We had bad monetary policies which caused rampant inflation like we are having right now. We had the government blaming the inflation on the war instead of bad monetary policies like we are having it right now. Remember, the Dow Jones Industrial Average opened at 1970 at 809 points and closed 10 years later in December 1979 at 839 points. Almost no gains at all. Stagflation, inflation at 20%, high unemployment rate, stagnant stock market returns in 10 years. When you factor in inflation, investors actually lost 49% of their money just by holding stocks. So stocks are out of question. Increasing interest rates environment is not good for bonds. As yield goes higher, bonds flush down. So bonds are out of question. If Fed wants to increase the interest rates, they gotta reduce the demand by crushing the housing market, stock market, job markets, and certain sectors of real estate will be down as well. So real estate is out of question. With US dollar keep making new highs, commodities like gold and silver are drilling down. So not a good investment as well. What is it? You say crypto? Well, moving on. But during 1970, there are two commodities that outperformed the markets. One, oil. Two, gold and silver. The prices of energy and commodities skyrocketed alongside with the inflation. Similar to the oil prices spike because of Russia, In 1970s, it's because of Arab oil embargo on US and Iranian war. The prices of energy soared. Gold and silver massively outperformed the overall commodity space during that time alongside with oil. Will they do it again? Oil already done it. Is it time for gold and silver to go higher? We gotta watch the US dollar for that. Once the dollar starts to crash, we will see commodities like gold and silver outperform. Until then, it's something to watch. So, brace yourself. When we get into a recession, knowing the Fed and their history under Powell and their predecessors, there is a chance that they will flip-flop and lower the interest rates to get the economy to stabilize by letting the inflation run for a while. If that's the case, it will kill the economy long term, but short term, we will get a massive rallies in both stocks and bonds. Hey, stocks are rallying, that's what matters. Am I right, Powell? Bunch of tickets. Anyway, thanks for tuning in. Check out the Patreon and join our community of great traders in the Discord. Link is down below in the description. I'll see you guys in the next one.